What if I told you one man, one single trade made over $1 billion? Not in a year, not in a decade, in a single day. He didn't build a startup, didn't create a product, didn't sell anything. He simply bet that an entire country was wrong. And he was right. This is the story of George Soros, the man who broke the Bank of England. George Soros was not born into wealth. He was born in Budapest, Hungary in 1930. He survived Nazi occupation as a teenager. He fled communist Hungary with almost nothing. He arrived in England as a broke immigrant with a suitcase and a dream. He worked as a waiter, as a railway porter, doing whatever he could to survive. But Soros had something most people don't. He was obsessed with how the world actually works, not how people think it works. He eventually got into the London School of Economics, and there, a professor named Karl Popper changed his life forever. Popper taught that our understanding of the world is always incomplete, always flawed, and that the gap between what people believe is true and what is actually true, that gap creates opportunity. Soros took that idea and turned it into a framework he called Reflexivity. Markets aren't just measuring reality, they're creating it. When people believe a currency is strong, they buy it and it gets stronger. When they believe it's weak, they sell it and it gets weaker. Perception is reality in financial markets. And if you can spot the moment when perception is completely disconnected from reality, that's where fortunes are made. To understand the trade, you need to understand the situation. It's 1990. Countries across Europe linked their currencies together in something called the exchange rate mechanism, the ERM. Britain joined in October 1990. The British pound was locked at approximately 2.95 Deutsche Marks. Britain committed to keeping it within a narrow band. There was just one problem. By 1992, Britain's economy was moving in a completely different direction. High unemployment, a housing market slump, a recession squeezing ordinary people across the country. What Britain needed was lower interest rates and economic relief. But here was the trap. If Britain lowered interest rates, money would flow out of the country as investors chased higher returns elsewhere. That would push the pound below its fixed rate in the ERM. Britain was stuck. You cannot serve two masters. You cannot run domestic economic policy for your own people and maintain an artificial currency rate at the same time. George Soros understood this. He saw it clearly, and he began to make his move. Soros, through his quantum fund, borrowed billions of British pounds. Then he immediately sold those pounds for Deutsche Marks. His bet was straightforward. If the pound fell, he could buy those pounds back at a cheaper price, return the borrowed money, and keep the difference as pure profit. By the time his position was fully built, Soros had reportedly borrowed and sold 10 billion British pounds. One position, one thesis, one man. His team was gathering intelligence constantly, analyzing data, reading political signals, and by late summer 1992, the signals were accelerating. The British government was spending billions of its reserves trying to prop up the exchange rate. But traders could see those reserves shrinking. Britain was running out of ammunition. September 16, 1992, a Wednesday morning. The pound was under massive selling pressure. No matter how many pounds the British government bought, the selling kept coming. At 7 in the morning, the government raised interest rates from 10% to 12%. The markets continued selling. By mid-morning, they raised rates again to 15%. 15% interest rates in a single morning. It was an act of desperation, and the markets knew it. George Soros held his position. He didn't panic. He didn't second-guess himself. He trusted his analysis over the noise. By mid-afternoon, it was over. At 7 in the evening, the Chancellor stood in front of cameras, visibly shaken, and made the announcement. Britain was withdrawing from the ERM. The pound was no longer pegged. Within hours, the pound fell dramatically. Soros bought back his position at a fraction of the price he had sold it for. The profit, over $1 billion, in a single day. For millions of British people, it was a disaster. The cost to the Treasury has been estimated at £3.3 billion. Businesses struggled. Homeowners suffered. Soros became a controversial figure. To some, he correctly identified a broken system and had the courage to act. To others, he weaponized markets against ordinary people for personal gain. But here's what no one disputes. You cannot fight market forces with political will alone. When the fundamentals are broken, the market will eventually correct. So what can you take from this story? Do your homework before you commit. Soros spent months studying the situation before risking a single dollar. The trade was the last step, not the first. Conviction is rare, When the government raised rates twice in one morning, most traders panicked. Soros stayed because he had done the work. Risk management matters more than confidence. Soros was obsessed with how much he would lose if he was wrong. Big rewards don't come from ignoring risk. They come from understanding it deeply. And finally, opportunity hides where most people see safety. In 1992, most people looked at the British pound and saw stability. Soros looked at the same thing and saw a situation that could not last. George Soros proved that preparation, patience, and independent thinking can beat institutions, governments, and conventional wisdom, not because the world is unfair, but because the world rewards those who see it clearly. Clarity is the real edge. Not luck, not connections, not even capital. Clarity.